What is happening in the world of digital assets right now? We're diving deep into the most explosive updates that you absolutely need to know. The market is moving at warp speed, and if you're not plugged in, you're missing out on the biggest moves. Get ready for a high-octane rundown that will keep you on the edge of your seat. We've got game-changing strategies, massive investments, and regulatory shifts that are set to redefine everything. This isn't just news, it's the pulse of the future, delivered hot and fast. Stick around because you won't want to miss a single second of this critical intel. Let's go. First up, a seismic shift from the titan of stablecoins. We're talking about major moves that could redefine speed and privacy in digital transactions. This issuer is shaking things up, pulling back from some networks and doubling down on others, all while forging a groundbreaking path with Bitcoin itself. What does this mean for efficiency, for security, and for the future of payments? You're about to find out. Next, we're looking at the big players, the institutions. We'll unpack the strategic allocations happening in the wake of massive macroeconomic shifts. Are the whales making a decisive move, and what signals is it sending across the entire market? This is the kind of insight that separates the informed from the followers. We're breaking down why this matters to everyone watching the charts. Then, get ready for the intricate dance of market cycles and capital flow as we explore the latest on altcoin rotation. What's driving these shifts, and where is the smart money heading next? We'll also dive into a company making bold moves, increasing its Bitcoin holdings, and expanding globally despite market turbulence. You won't believe their strategic foresight. And finally, we close with a crucial look at regulatory frameworks and their impact on adoption. Make sure to smash that like button, subscribe for more, and ring that notification bell so you never miss an update. Stablecoin supremacy, a new Bitcoin frontier. The stablecoin giant is making waves, announcing a significant pivot in its operational strategy that could dramatically alter the landscape of digital currency transactions. In a move that has sent ripples through the crypto community, the world's largest stablecoin issuer has decided to sunset its presence on 5 legacy blockchains: OmniLayer, Bitcoin Cash SLP, Kusama, EOS, and Algorand. This decision, influenced by community feedback, signals a strategic refocusing on networks with higher activity, greater scalability, and stronger developer engagement. While users will still be able to manage their existing tokens on these chains, the cessation of new USDT issuance and redemption marks a clear departure, effectively marking the end of an era for USDT on these less active platforms. This streamlining aims to enhance efficiency and concentrate resources where they can yield the most significant impact. But the story doesn't end with departures. It accelerates with new integrations. In a groundbreaking development, Tether is launching its USDT stablecoin on the RGB protocol, a Bitcoin-anchored layer known for enabling incredibly fast and private transactions. This integration leverages client-side validation and promises near-instantaneous settlement times, especially when combined with the Lightning Network. It represents a major leap in bringing robust stablecoin functionality directly to the Bitcoin network, capitalizing on Bitcoin's unparalleled security while vastly improving the user experience for stablecoin transfers. This move aligns with Tether's broader investment strategy in the Bitcoin ecosystem, which includes over $2 billion poured into mining facilities, with ambitious plans to become the largest BTC miner by the close of 2025. This deep integration suggests a future where Bitcoin is not just a store of value, but a high-performance network for digital currency transactions. Meanwhile, the Tron network continues its reign as the dominant force in stablecoin circulation, particularly for USDT. In the second quarter of 2025, Tron's network saw over $80 billion in USDT transactions, processing a staggering daily volume exceeding $23 billion, thereby eclipsing Ethereum in this specific metric. This dominance is largely attributed to Tron's exceptionally low transaction fees and rapid settlement capabilities, further cemented by the default preference for TRC-20 USDT on many exchanges. While Ethereum still leads in decentralized finance and NFT markets, its stablecoin activity has seen a decline. The trade-off, however, lies in Tron's more centralized structure, with only 27 validators compared to Ethereum's thousands, which inherently impacts network security and decentralization, even as it delivers speed and affordability. Adding another layer of significance, the U.S. Genius Act is set to introduce a comprehensive regulatory framework for stablecoins. This legislation mandates a strict one fiat backing for all stablecoins, ensuring greater transparency and stability, and prohibits their marketing as federally backed assets. Analysts predict this regulatory clarity will foster increased trust among both consumers and institutions, paving the way for widespread adoption in everyday payments and remittances. The act also opens avenues for major financial institutions like J.P. Morgan and Citigroup to explore stablecoin issuance, potentially integrating them into traditional financial systems. This regulatory push, coupled with the inherent cost efficiency of stablecoins, often costing less than 10 cents per transaction compared to credit card fees exceeding 3%, positions them as a powerful alternative for global remittances and micropayments, potentially slashing the World Bank's estimated 6.62% average cost for international transfers. But what does this regulatory push mean for the everyday user? And how does this impact the broader financial world beyond just stablecoins? Institutional realignments, navigating the macroeconomic tides. In an era defined by persistent macroeconomic shifts and evolving financial landscapes, institutional investors are strategically recalibrating their asset allocations, with a notable emphasis on Bitcoin. This trend signifies a growing recognition of Bitcoin not merely as a speculative asset, but as a potentially crucial component of a diversified investment portfolio, capable of offering unique uncorrelated returns and hedging against traditional market volatilities. The current economic climate, marked by inflation concerns and geopolitical uncertainties, has prompted a reassessment of traditional investment strategies, leading many institutions to explore alternative assets that can provide stability and growth potential. This strategic allocation by institutions is not a monolithic event, but rather a nuanced approach driven by a confluence of factors. Firstly, the increasing maturity of the digital asset market, evidenced by the development of robust infrastructure, regulatory clarity, albeit still evolving, and the proliferation of investment vehicles such as Bitcoin ETFs, has lowered the barrier to entry for large-scale investors. These developments provide greater confidence and easier access, enabling institutions to integrate Bitcoin into their portfolios with greater ease and compliance. The perceived scarcity and digital nature of Bitcoin, often likened to digital gold, make it an attractive hedge against currency debasement and inflationary pressures, a narrative that resonates strongly in the current economic environment. Secondly, the performance of Bitcoin relative to traditional assets during periods of market stress has also captured institutional attention. While volatile, Bitcoin has demonstrated instances of decoupling from traditional markets, offering diversification benefits that are highly sought after by portfolio managers. The narrative of Bitcoin as a risk-on asset is increasingly being challenged by its behavior as a digital gold hedge, particularly during times of significant macroeconomic uncertainty. This dual narrative allows institutions to position Bitcoin not just for capital appreciation, but also for portfolio resilience. Furthermore, the growing acceptance and integration of digital assets into mainstream finance are playing a pivotal role. Major financial institutions, including banks and asset managers, are increasingly offering digital asset services, creating a more accessible and regulated environment. This institutional adoption is not just about direct investment. It also involves providing custody, trading, and other financial services related to digital assets, further legitimizing the space and driving demand. The ongoing development of regulatory frameworks globally, while presenting challenges, also provides a clearer path for institutional participation, mitigating some of the perceived risks associated with regulatory uncertainty. The implications of this institutional adoption are far-reaching. It signals a potential long-term structural shift in asset allocation, where digital assets, led by Bitcoin, could become a standard part of institutional portfolios. This influx of capital can contribute to market stability, reduce volatility over time, and further legitimize the asset class. It also sets the stage for broader market acceptance and the development of more sophisticated financial products and services built around digital assets. As more institutions enter the space, the network effects are expected to grow, further solidifying Bitcoin's position in the global financial system. But is this institutional embrace a sign of sustained growth or a temporary trend? And what does this mean for the upcoming market cycles? Navigating the cryptocurrency, altcoin rotation and market cycles in 2025. The cryptocurrency market, ever dynamic and complex, is currently exhibiting patterns of cyclical downturns, which in turn are fueling a significant rotation into altcoins. This phenomenon is not merely a random fluctuation, but a predictable, albeit intricate, dance of capital seeking higher returns and diversification amidst broader market trends. As Bitcoin, the market's bellwether, experiences its predictable cycles of consolidation and potential downturns, investor attention invariably shifts towards the altcoin market, where smaller cap assets can offer exponential growth potential. Understanding altcoin rotation requires a grasp of market psychology and capital flows. During Bitcoin's bear cycles or periods of stagnation, investors often look for opportunities to outperform. Altcoins, with their lower market capitalizations, are more susceptible to rapid price appreciation when capital flows into them. This dynamic creates a cyclical pattern where periods of Bitcoin dominance are followed by phases where altcoins capture significant market share. The year 2025 appears to be a prime example of this, with analysts observing a strategic reallocation of funds from Bitcoin into promising altcoin projects, driven by a combination of factors including technological advancements, emerging use cases, and the sheer potential for outsized gains. The drivers behind this altcoin rotation in 2025 are multifaceted. Firstly, the maturation of certain altcoin ecosystems, such as those focused on decentralized finance, DeFi, non-fungible tokens, NFTs, and Layer 2 scaling solutions, has generated substantial interest. Projects offering innovative solutions to existing blockchain limitations or creating entirely new markets are attracting significant venture capital and retail investment. Secondly, the anticipation of upcoming technological upgrades or tokenomics changes within specific altcoins often triggers speculative buying, further accelerating the rotation. Investors are meticulously researching projects, identifying those poised for significant development or adoption. Moreover, macroeconomic factors continue to play a crucial role. In an environment where traditional markets may be experiencing uncertainty or sluggish growth, cryptocurrencies, including altcoins, can be seen as attractive alternatives for yield and growth. The search for yield, particularly in a low-interest rate environment, often pushes investors towards riskier, higher-reward assets, which altcoins represent. The increasing institutional interest in the broader digital asset space, as discussed previously, also indirectly benefits altcoins by bringing more capital and legitimacy to the crypto market as a whole. The implications of this altcoin rotation are significant for both seasoned traders and newcomers. For traders, it presents opportunities for substantial profits, but also introduces heightened risk. The volatility of altcoins means that while gains can be rapid, losses can be equally swift. For the broader market, this rotation signifies a healthy diversification of capital and innovation. It supports the development of a more robust and varied crypto ecosystem, moving beyond a singular reliance on Bitcoin. As capital flows between Bitcoin and altcoins, it tests market resilience, fosters competition, and ultimately drives the evolution of blockchain technology and its applications. But how do these market cycles and rotations affect the average investor's strategy? And what are the key indicators to watch for the next big altcoin move? SWC's bold Bitcoin gambit, growth amidst market turbulence. The smarter web company, SWC, has recently underscored its commitment to a robust growth strategy, marked by a significant capital raise and a strategic expansion of its Bitcoin holdings. In a decisive move, the company announced the successful acquisition of £3.7 million, a substantial injection of funds earmarked for global expansion and long-term development initiatives. This financial bolstering is complemented by a strategic shift in their auditing services, transitioning to PKF Littlejohn, a move CEO Andrew Webley described as essential for aligning with the company's evolving operational needs and future trajectory. This proactive financial management positions SWC to navigate the inherent volatilities of the market with greater resilience. Central to SWC's strategy is its increasing allocation to Bitcoin. The company recently acquired an additional 45 BTC, elevating its total holdings to an impressive 2,440 Bitcoin. This substantial reserve not only solidifies SWC's position as a significant player in the digital asset space, but also ranks it among the top 25 entities holding significant Bitcoin treasuries. Webley expressed unwavering confidence in this strategy, acknowledging the market's volatility, but emphasizing that short-term price fluctuations do not deter the company's long-term vision. This conviction highlights a growing trend among forward-thinking companies to view Bitcoin not just as an investment, but as a foundational asset for future growth and operational stability. SWC's engagement with the global cryptocurrency community has also been a key focus. CEO Andrew Webley's participation in the Bitcoin Asia Conference in Hong Kong served as a critical platform for forging industry connections, exploring potential collaborations, and engaging directly with the broader crypto ecosystem. These interactions are vital for maintaining visibility, gathering market intelligence, and fostering strategic partnerships. Webley's commitment extends beyond professional networking. He also made time to connect with community members, reinforcing the company's people-centric approach and its appreciation for the community's role in its success. The growth of SWC's online community, particularly on the X platform, has been remarkable, with over 4,100 new members joining in the past 4 months. Webley attributes this expansion to the active participation and mutual support within the community, especially during challenging market conditions. He stressed that this vibrant community is instrumental in reinforcing SWC's mission, fostering a shared sense of purpose, and driving collective progress. This organic community growth is a testament to the company's effective communication and its ability to cultivate a loyal and engaged following. Despite facing recent pressures on its share price, SWC's leadership remains optimistic and focused. Webley acknowledged the psychological impact of market volatility on shareholders, but reiterated his strong belief in the company's execution capabilities and strategic direction. He extended gratitude to shareholders and the community for their continued support, recognizing their collective role in achieving milestones such as the capital raise, auditor transition, and the significant expansion of the Bitcoin treasury. This resilience and forward-looking perspective are crucial for any entity operating within the dynamic digital asset landscape. But what does this strategic focus on Bitcoin mean for SWC's long-term valuation? And how do other companies compare in their digital asset treasury strategies? And that's a wrap on today's essential updates. We saw Tether revolutionizing stablecoin speed and privacy on Bitcoin, institutions making strategic moves amid macro shifts, altcoin rotation heating up the market, and SWC doubling down on Bitcoin despite volatility. Don't miss out on the next wave of insights. Hit that like button if you found this valuable, subscribe to Bitcoin Bulletin for your daily dose of crypto intelligence, and ring that notification bell so you're always the first to know. Follow us on all social platforms for more real-time updates and join the conversation. We'll see you in the next one.